Good afternoon, everybody. My name is Geoff Pollock, and I'm joined together with my good friend Victor Bruda, and we're presenting the third in our series of Lunch and Learns. And today we're going to be talking about mastering real estate financing. Previously, we've done two other webinars. One is successful closing strategies, and the other is crafting the perfect APS. Now, before getting into the nuts and bolts of this presentation, I wanted to talk about something that came up that was very timely. Many of you may have seen in the news about the double murder suicide that happened last week in it was around Don Mills and York Mills area. And that actually is just a few blocks away from my office. Now, you may be asking yourselves, what does a double murder suicide have to do with financing with private mortgages? Well, in this particular case, it has everything to do with it. The person who allegedly perpetrated the murders was involved in, was a victim, and his family was a victim of mortgage fraud, and his family wind up losing their life savings. There were numerous people that were charged. Somebody was convicted, went to jail, pled guilty. There were several lawyers who lost their licenses. And this ties into some of the issues that can come with private mortgages. And there are just a couple of lessons to be learned from this. The first lesson is be careful. If something is too good to be true, it probably is. If something is a guaranteed absolutely no ifs, ands, or about it, slam dunk that you can't lose money, the only guarantee is you probably will lose money. There are the only guarantees in life are death and taxes. Another issue is if you're going to be involved in a private mortgage, don't be involved with a rookie lawyer who has no experience. In this particular case, the lawyer was newly called to the bar, never registered any of the mortgages that were done. So these are just a few things to bear in mind. And this tragic situation in which several people lost their lives and many families lost their entire life savings. Be careful. There is no substitute for due diligence. And again, as you've been told since you were a child, if something is too good to be true, it is. So having said that, let's turn right into our agenda. So we are going to be discussing a few different things today. We're going to be talking about the differences between bank lending and B lending. Then we're going to talk about how to leverage private mortgages when traditional banking isn't an option. We're going to be going over various refinancing strategies, and as well as the ins and outs of securing construction loans. And of course, we'll be having question and answers. You don't need to wait till our Q&A session. Feel free to post the Q&A in the chat, and we'll be delighted to answer your questions. Just a quick introduction about myself. I'm Geoff Pollock. I'm a real estate lawyer. I'm a former bencher in the Law Society of Ontario and a former member of the Law Society of Ontario's Real Estate Liaison Group, and I'm the president and CEO and co-founder of Master Re. Victor Bruda and I have been working together for over a decade. Victor is right now the president of construction financing at the Financial Capital Center. Before this, he'd been involved in banking for over 17 years. He's done everything from mortgages to balance sheet lending. And over the time that Victor and I have worked together, we've done tens of millions of dollars of deals together. He's been a mortgage agent, operated a branch for a private lender, and currently he is the risk manager for two different mortgage investment corporations. And Victor brings a wealth of experience to the lending. Victor, do you want to talk about the differences between bank and B lending?
Certainly. Thanks, Geoff, for the introduction. So what's happening today is that the banking system has pretty much stayed the same, where they look at the four C's, which I remember back in my banking days going back 40 years ago. Capacity, credit, collateral, and character were the four main issues. Capacity being the most important to the bank, being the GDS and the TDS, and the credit scores, of course, and then the collateral and the character of job stability being secondary. The difference between an A bank and a B bank is that you still got two good clients, but in most cases, the B lending is for clients who are either business for self or have different forms of income and perhaps are not putting on their NOAs their full income because they're not withdrawing from their company as much money because a lot of the expenses get paid through the company. So the B lender will look at different aspects of the client's income, such as they'll look at bank statements, they'll look at financial statements, they'll look at other sources of income. And as long as they can develop the fact that the client has the ability to pay while it not be on his NOA, they're happy to deal with the customer, given the fact that he still has a good credit rating and the collaterals within the LTV. So it's kind of pick your choice. Either you pay more income tax or you're going to pay more of an interest rate. And depending on how much you borrow and what the costs are involved, you may look at that and say, I'd rather pay a little higher rate, go to a Schedule B bank, but not have to withdraw an extra 2 or 3 or 400,000 out of my company to get an NOA that's going to take me to a bank.
And one of the things with that is very important, and to everybody who's attended our previous sessions knows that I keep talking about know your client, know your client, know your client.
Right.
And we had a situation that somebody was applying for the loan. They only showed an income of maybe $100,000, and it was millions that they were seeking. And we're like, well, you don't really have the capacity. Well, do you have other sources of income? Are there other things? And this individual didn't put down his corporation, and which of course was making millions of dollars and had enormous asset, and he was the sole owner of the corporation. So you need to probe a little bit with your clients. Don't just accept everything that they say at face value. Just seek a little bit more information, and then when you have a fuller we have fuller picture of their financial situation, you can provide them with the best possible advice and steer them in the right direction.
Agreed. Absolutely.
So in terms of comparison of the interest rates and the terms, one of the differences between this is that typically the A lenders, they typically have lower rates. And you may find more flexibility, however, in the terms with a B lender. And because they tend to have a little bit more flexibility, a little bit less tied into the rigid processes. And speaking of the process, do you want to talk about the eligibility and approval process, Victor?
Yeah, so traditionally we know banks normally take a longer period of time. They have a different sort of level of approval process, so it has to go to a certain level based on certain amounts that you're borrowing and the quality of the application. So what we're finding is that the Schedule B banks are usually a bit quicker in making these decisions. They're for some reason getting probably more information than a Schedule A bank, as you suggested, that there's financial statements and all other things they will take in account. So we're finding that the Schedule B banks are a little bit quicker, although of late they've been a little slower due they're getting a lot of business based on today's rates. But generally speaking, the process for a bank usually takes up to 60 days. from what I'm hearing, and from what I'm seeing on the B lending right now, it's about 30 days.
And if you have a client who's needing financing, it's never a bad idea to, before putting in an offer of purchase and sale, to obtaining the financing or getting a pre-approval and starting the ball rolling right away. And also that way they know, are they going to qualify for an A bank? Are they going to be a B bank
Mhm.
lending? Or we're going to get into later some other exotic options for them.
Right.
And in terms of the pros and the cons, really the pro of the A bank lending is, it's, if you're in a plain vanilla situation, it's probably the easiest and you'll probably get the lowest rates. If you work in, so perfect example, you work for a rock solid company, you work for a bank yourself, you work for the government, you make X number of dollars every year, they can lock that in. They know exactly how much you're going to make, your ability to pay, and they can spit it out and give you the rate. Whereas if you are self-employed, you've got business that a little bit different than what an A bank has, and you don't fit neatly into that square box. That's more when you want to be going for the B lender. The downside is sometimes you may need to pay a little bit higher rate, but that can depend. You may qualify for an A lending, but they don't take into account all of your other assets, all of your other income. A B lender would, and the B lender may give you a better rate than the A lender in those circumstances. So in terms of the how to leverage a private mortgage, do you want to talk about the advantages of private mortgages, Victor?
Yes, I always look at private mortgages as being a more of a short-term solution. I've been doing private mortgages for many years, and most of the deals that I do don't extend beyond 12 or 18 months, or they shouldn't, because they're obviously a higher rate. And depending on what you're borrowing the money for, you got to look at whether or not, after you pay all your costs, the fees, and arrangements, is it, are you still making money, or are you losing money if it's for investment, and if it's for some type of consolidation, or for you to deal with some matters that you need to clean up, whether or not it's going to work for you. But the bottom line is there has to be some sort of equity in the property, and there also has to be some sort of exit strategy, because it's not something you want to keep like you would on an A or a B banking system for a 5-year program. It's too expensive.
So one case where we use private mortgages is in a situation that somebody dies, the
Mm-hmm.
estate takes over, and we have an appointment of a state trustee, and looking at the house, it's not in great shape. And so in order to maximize the value, you may want to do $100,000, $200,000 in renovations, really get it up to the standard to maximize that the potential payoff for that. If you are an estate trustee, it's going to be very difficult for you to get A lending or even B lending, because they would want you as an estate trustee to personally guarantee that mortgage. Whereas if you are going to a private mortgage, they'll say, okay, it's a house worth $1 million. There's zero mortgage on it. Sure, we'll give you $200,000 or $300,000. And in this case, there's also a real flexibility in terms of private mortgages, because a lot of private mortgages are going to be interest only. And so you're not going to need to make that the repayment of principal. And a matter of fact, in some of these cases, you'll have what they call an interest reserve. So they'll notionally advance you, say, 6 months worth of payments, but you don't actually have to make those payments because it's already been advanced. So those are circumstances when private lending makes a lot of sense, and particularly when you need to be agile. And private lenders look primarily at the value of the asset. and then they look at some of the other criteria. So that's a really good situation to utilize a private mortgage. So in terms of who can be a private lender, anybody can be a private lender. I've got a lot of clients who individually, they want to loan out money. They want to make money in a short term, and they will come and they will say, okay, I want to invest in this criteria. I want to be in first position, 65% loan to value, those sort of things. Now, those are people who are sophisticated, who have quite a bit of liquid cash they needed to deploy. And they also have the ability to absorb if there are going to be issues with the mortgage, if it needs to go into a notice of sale, if they need to take it over. Those are the type of people who are private lenders. Now, there's another category, which are mixed mortgage investment corporations, mortgage investment trusts. And this is where somebody invests into a pool of mortgages. And that spreads out the risk considerably, because you don't invest in one mortgage where something could go wrong, and be it with the borrower, be it with the property, something, for example, there could be an environmental issue that's discovered afterwards that affects the investment. So this is where people invest in a pool of mortgages, and they have somebody, usually experts, who do take care of all of the underwriting. But in terms of a lot of those mix or mortgage investment trusts, you need to be an accredited investor. Victor, do you want to take us through the loan application process?
Sure. So on private mortgages, as Jess mentioned, the appraisal is a very important aspect, because it's mostly equity based. So private mortgages are certainly looking at getting a quality appraisal to determine the value. So because a lot of it's based on loan to value. And as I mentioned, they also look at, what is the ability of the client to exit, because this should not be a long-term thing. Most private lenders don't need as much documentation as an A or B lender, because they're, again, looking just at an equity base and looking at whether they're going to finance the interest or whether the client's going to pay the interest. So a lot has to do with the ongoing discussions, and probably less paperwork. The other thing is the terms and the conditions are usually very flexible, and private mortgages are usually approved within a day. So they're not that difficult if you've got the documentation of a good appraisal, the application. I personally like to see NOAs, only because I want to make sure there's no CRA issues, but in a lot of cases that is not done. So but the loan process is very quick. People come to it if they got to close quickly, or something came up, they thought their property was going to sell, it didn't sell. So it is a very, very quick process in most cases.
So one thing that Victor touched on earlier, I just want to highlight, that is really, really important for private lenders, as opposed to the bank lenders or the tier one lenders, is the story. And because you go to the bank, they want you to lock in for 5 years. Private lenders, they're looking for 1 year, 6 months, year and a half, maybe 2 years at the outset. They want to know the story. Why are you going for a private mortgage? What is your exit strategy? What is behind it? I've dealt with situations where I mentioned earlier about the estate sale. Another situation is there is a marital breakdown. Somebody winds up getting the house in the proceedings. The separation agreement is finished. Then that spouse realizes that they are not going to be able to maintain the house, want to sell the house, but they want to, and they need to do some renovations in order to maximize the value of that asset. So this is a situation, maybe they own a house, 1.5 million in this particular situation, but they were homemakers, so they essentially had very little to no income. So this is something that the banks wouldn't want to touch. Private lender, happy to get involved in this. They come with an estimated budget, $100,000, renovation on $1.5 million asset. Private lender is only too happy to do a deal like that and can be done very, very, very quickly. So getting the story from your clients is very important to a lot of private lenders. And frankly, a lot of private lenders like to help people. And they want to say, okay, somebody who falls through the cracks, doesn't really fit in any of the other categories. They like to help them. So we touched on a little bit of the terms and conditions. Do you want to expand on that a little bit, Victor?
Yeah, so most of the terms, are pretty much with option. Like there's some privates that want to close mortgage, they want to know that their money is invested for the long term, being the year. There's some that will do the 6 months. Most conditions we like to see are that it is open for repayment. And because we know that in cases where clients, maybe things didn't turn out exactly how they are, that getting a renewal can be very expensive, because you normally, private lenders, whatever they charge at the beginning, they're going to charge again going through another year process if for whatever reason the exit didn't occur. So the terms, as I mentioned, they're usually fit to what you mentioned is the story. And if that works out, then it should be lend the client the money, he repays it, and it all works out for everybody. It's a win-win. But in case it doesn't, the problems exist of getting back into the expense, other than probably the legals of having to go through fees and renewal costs, etc.
Excellent. And in terms of the risks, what are some of the best strategies to mitigate the risks involved with private lending?
In my opinion, I like to see every project that I do. So whether it's a project, like if it's a private lending, if it's on the house, because we're only private lending in certain areas that are all within distance for travel for us. I like to see the property, and in a lot of cases, when you see the property, you get to meet the people. And I think once you meet the people, you see the property, you get a good feel for whether this is going to work for them and work for the private investor.
One other thing that helps mitigate it from the lender's perspective is if they have a prepayment of the interest and have an interest reserve of 6 months. That gives a lot of comfort to the lender to know that they're going to be covered.
Right.
So in terms of some of the legal and tax considerations, one thing that is very common these days, and so people may have a first mortgage with a tier 1 bank. They then want a second, and they're not able to go through the bank to get the second. Maybe they want to do some renovation. Maybe this is to invest in their business, what have you. So they want to, and they're not able to go to, they need to go to a private lender. So in terms of this, there are increasingly, the banks are putting provisions on their charges that prohibit any second or any subsequent registration of any security absent their consent. And a lot of times they're just throwing these on without people being aware of them. Another issue is a lot of the banks are commonly doing chattel mortgages. So let's say you are buying $1 million house, you're only borrowing $800,000 from the bank, yet the bank wants to register a mortgage of a full $1 million, the full purchase price of the mortgage. And in some cases, we've had situations where clients say, no, I'm only borrowing 800,000. You're only registering 800,000. They say, well, we're giving you a chattel mortgage. This way we could give you a line of credit afterwards, other products, not without having to do other registrations. And my client said, no way, no how. And they said, well, the only way we're going to give you the mortgage is if we register the full amount of the purchase price. Otherwise, we're not doing it. And in this case, my client said, okay, no way, no how, I'll find a different bank. It's hard though when you only find this out a week before closing. In this particular case, they had a really good relationship with another bank. We were able to get it done, but it can be very, very tricky. Now, one tax consideration that I want to bring to your attention is we mentioned before that a lot of people have private corporations, and Victor was mentioning that people may not necessarily want to remove money out of their corporations. So let's say somebody is in this situation and they think, well, I want to get a cottage. I've got tons of cash in the corporation. What if I do a private mortgage? The corporation does a private mortgage to myself. And in this case, at zero interest, and then I can repay it. I don't need to take money out of the corporation. So if it is a non-arm's length entity, individual, then you get into the issue that this may be deemed by the CRA to be a taxable benefit to the individual. And then, of course, we have a situation, essentially, you're getting double taxation because the individual has the taxable benefit, but the corporation cannot claim any deductions for this. So you want to be very, very careful with this. Now, I am a lawyer, I'm not an accountant. I strongly suggest you speak to an accountant. My wife is an accountant, and this is where I get all my information is from her. So before doing anything like that, please speak with your accountant to make sure if it falls or doesn't fall within the head of this. Victor, do you want to maybe talk about a case study or a success in
Well,
terms of this?
yeah, I was actually thinking, actually, the one that we did years ago, where the husband lost his job. They started falling behind on their bills. They came to us. They were in arrears. The OCRA some money. It just started to get way out of hand, and they decided they were going to sell the house, but they didn't want to go. They didn't want to make sure that they were able to sell it under their terms. So they came to us, and we did a consolidation for them. We brought all the mortgage up to date. We gave them like an interest reserve and then, so they had enough money going forward. And we were able to sell the house through a normal process, and the house got sold. The private mortgage obviously got repaid along with the first, and they came out with some equity, which was nice because we all know if it goes under power of sale, the chances are people are looking at perhaps paying a different price for the house. So they were happy campers. I mean, they got we fixed up their problem. We got them through. They got to sell it under their own terms, and they got what they wanted for the house, and they were still able to take that equity and buy another house. So it was really a great story because, again, the private funds that we put in place left it so they could get to that next step.
I remember that deal well.
Yes.
Yeah, they were very, very pleased.
Yeah.
So those are the sort of situations that are absolutely perfect for private mortgages. And we're going to talk a little bit more about a different kind of private mortgage in terms of construction financing in a little bit. We'll talk about other situations for this. So now we're going to talk about various different refinancing strategies. Do you want to talk, Victor, about the benefits of refinancing, the types of refinancing options that are available?
Well, there's refinancing either within you first, depending on when it's due, or getting a second. And some banks are doing seconds and home equity loans. And I think what you got to look at is what your benefit is. Obviously, if you got high credit card debt, you got things that are pressing, maybe you got into some heavy expenses with car or the house. So taking debt that might be out there at high interest rates, especially in credit cards, is sometimes not a bad idea if you can control not going back to that. Because you can lower your monthly payments by doing a refinance. So the option of doing that will depend on what you're paying out. But obviously, with credit cards being at 25 and some at over 20% or north of 20, there's lots of room to save a lot of money on any exterior type of financing outside of mortgages.
So, and those are some of the considerations in terms of refinancing. Uh, Victor made a great point. Is in terms of credit card debt, you need to make sure that you don't or the person doesn't go right back into the same hole in which they're just getting out of. And so, in terms of cost benefit analysis, look at in terms of what would be the reduction in my monthly payments. Am I going to be able to stay within the monthly payments, or is this just essentially an entirely new way of financing? I'm going to find myself right back where I started from very soon. And this gets into the common pitfalls and how to avoid them. So you want to look at what your total costs are. Are you going to be able to live within this budget? Another thing is, and when I was in the Canadian Army, they said never, ever, ever panic. And sometimes people refinance out of panic. Consider what you're doing and consider what the best options are. So I've seen people that refinance or getting a second mortgage, but they don't line up the timing with their first. And so what this means is if they're when they go to refinance their first, they may not be able to get financing somewhere else because it would have to go behind. Or if they wind up selling their property, they don't have that flexibility. They may need to pay break penalties if it's a closed mortgage. So look at, is it a closed? Is it, are you going to do, is it open? What are the repayment terms? And also when does the repayment date fall into? These are some things that you want to do to look at to avoid falling into a bad situation. So as promised, here we go into the ins and outs of construction financing, something both Victor and I have lots and lots of experience with. Victor, what is a construction loan?
A construction loan is where someone comes to us. They've either looked at a property to totally do a demo on it and rebuild a new house, or they're looking at a conversion, or they're looking at doing some type of renovation to the house. So that would fall under the construction loans for us.
Okay. And how are you, what is the eligibility criteria for construction loans?
A lot different. Obviously, we take the same type of paperwork with applications, NOAs, identification. But we're more concerned about the project getting finished because that's where the value is. So when we're looking at construction loans, we're always looking at the as-is value and the completed value. We're also very, very interested in execution. Who's the builder? Is he experienced? The biggest problems we've seen in construction is the lack of timelines, getting the project finished in time, and really we find that any self builds are probably a no-go. We've noticed that a lot of people, even though they've probably done some renovations or maybe been slightly involved, you can't do your full-time job and build a house, so it just doesn't work.
There's a big difference between building an extension or redoing your kitchen and building something from scratch.
Right.
And Victor mentioned earlier character. And in this particular case in construction, it's the experience. What have they done? What is their portfolio? Have they shown the ability to execute on projects like this, to get it done, to get it on budget, to get it on time? And the ability to build things in a timely fashion is more important than it's ever been, or at least this side of the 1980s, because interest rates are so high. And so you need to be dealing with an operator who has a track record of being able to deliver. So, and the documents, Victor touched on a little bit, are going to be everything that was required before, but then some. So you're going to need to have site plans, architectural drawings, consultants. So these are some of the, what am I forgetting with respect to
Um,
the
yeah,
documents?
we need the permits and drawings, of course. We like to get not only we like to get the budget. Usually the budget is reviewed at the site with the builder or the project manager to determine whether or not they can actually build a house. We find that applications that come in, generally everybody thinks they can build a house cheaper than anyone else. So when they're coming in from, what I consider not your normal type of builder, but somebody who's doing who's bought a lot and wants the house for themselves, that they have really not the understanding of really all the things in the budget. So it's very important to have the budget, the cost estimation to be very, very close, because there's always going to be add-ons, people get involved, and once they get going and adding on things as well. So it's important to make sure that the budget is as close as you can get.
So, which sort of brings us to the distribution or disbursement process. And then with this, it ties into the budgeting and cost estimation, because for construction financing, you must take into consideration there is going to be the construction lien holdback. So this means that the lender is going to hold back 10% of all the funds that they are advancing. So if they are doing an advance of, if there's $1 million construction or $1 million facility, and they're advancing in different tranches, 100,000 a tranche, they will only advance 90,000, and they will hold back that 10% in case there are any liens. And this is statutory provisions in terms of construction lien holdbacks. And it is surprising the number of builders out there that don't account for this and that think they're going to get 100% of the money and don't realize it until there's a problem. So typically what will happen in terms of construction lien advances, they will go to the lender. They will say, okay, I have completed, I've now put all the foundations in place. The lender will come out. They will have a quantity surveyor typically, or they may come out themselves. They will confirm the work, and they will say, okay, you have done now $100,000 worth of work, and we are giving you 65% loan to value. So we'll give you 65,000. However, we're not really giving you 65,000 because we're holding back that construction lien holdback. So these are the things in terms of how the disbursement happens. It can happen anywhere between taking a couple weeks or a couple days, depending upon how busy the lender is in terms of the ability to execute and execute quickly, and the ability of to go out and have a site visit. So in terms of interest rates and repayment terms, Victor?
Yeah, so the interest rates are normally a little bit higher on construction because they are a little bit more risk sensitive. The repayment terms are normally not till the house is finished. As you mentioned, there's a 10% holdback. There's also the interest costs and possibly overrun. So it's very important that that there is some sort of exit plan. Are they selling the property? Are they going to refinance? And if they can refinance, Do they have the ability to refinance it? So, but normally the repayments, the rates and the repayments are, like I said, just a little bit higher because you're dealing with the client on usually a monthly basis. Most private or construction financing is done with many draws, especially on the more infill type lot. So it gives the client better cash flow, which we like to see to get the timely manner of completion. So that's what we're finding right now. It's usually a little bit more expensive, but it's you're not paying it. You're only paying interest on the amount that you're borrowing and advancing. So that's the good part of it.
And in terms of repayment terms, this can vary widely depending on the type of construction that is being done. So, for example, if you're doing building a dozen stacked townhomes, you may have a situation where you discharge individual mortgages based upon when each individual unit is ready. And that's when you want to work with a lender that has that flexibility to be able to accommodate that. So I'm now going to turn to Mastery, which Mastery is a real estate transaction system. It's software as a service, and we call it real estate transaction management made easy. This is designed for the Canadian market and tailored to individual real estate brokerages. So if we look at some of the things that Mastery solves. So if you take an issue, the problem is a lot of brokerages are using Excel or using fillable PDF for their trade record sheets. This tends to lead to errors, duplication, and in terms of data entry. The solution is Mastery software will cut the paperwork and the errors, and will cut the amount of time that you need to spend by over 50%. There can be a problem coordinating transactions, invoicing, trust accounting. It's consuming and it's challenging. To approve a deal and generate a commission statement in the Mastery software is so easy. You can literally generate a commission statement in 60 seconds. I invite you to look at our web page. There'll be a link to a little video I have on how easy it is to generate the commission statement, literally 60 seconds, and maybe 68 seconds. And we can also generate all and reconcile all of the trust accounts right within Mastery. Now, many of the other products out there are not designed to comply with Ontario regulations and legislations. Mastery was designed by Ontario real estate professionals, brokers, real estate lawyers, accountants, to ensure seamless compliance with all the Ontario regulations, and all of our data is hosted right here in Canada. One thing that we have available, a little handy tool that a lot of agents love, and is our commission calculator. Anybody can use this. Just go to our website, mastery.ca. If you've got a deal that you want to find out approximately how much your commission are going to be, you put in the sales price, you put in the commission, if there's any rebate applicable, if there's a referral fee, you put in your split with the brokerage and what your annual cap is, and if your cap has been reached or not. And there you go. Right there, you see that in this particular case, there's going to be $27,500 that is going to be the commission from this particular sale. So now I will turn to the question and answers. We've got a few questions. So the first question, Victor, is how is an Alt A different from a B lender?
Well, okay. Can you say that again? I'm sorry.
How is an Alt A different than a B lender?
Alt A. I'm not sure. I'm not sure you mean by Alt A.
So I'm not 100% sure on that either.
Yeah.
are we talking more? And whoever it was that sent this, please feel free to jump in there and just clarify that. Are you more referring to like a national bank, like something that's a tier one let or Schedule A bank, but not quite as big, or maybe a smaller actual bank? I would say up until a month ago, HSBC, before they were swallowed by RBC, might fit that category. So if you want to maybe just clarify that, please do. Um, there's another question. How would you handle a mortgage renewal this year? Victor, what would your
Yeah.
advice be for that?
Well, that's probably the biggest question that's going on right now. And I've always been the type of person who likes to look at the overall cost of everything. I think a lot of people look at a problem as being maybe bigger than it is. I would suggest anybody who's got a mortgage coming due this year to look at what they're looking at in additional costs. And by them doing that, I know banks are being very flexible right now. They're giving borrowers longer amortization periods. They're working with them to try to keep the payment as close as possible, even though the rates have gone up. But what I would do before you decide to move or go to another province or make some big changes is look at the actual amount of money you're looking at in this particular time if you have to go another year. Because we all know and we all feel that if there is going to be a rate reduction, we're going to see some this year, probably more next year. And if you can get by this year, the chances are next year you'll get something closer to what you're paying maybe when you originally got the mortgage. So to answer the question, I would say look at the costs. It costs a lot of money to sell your house, and then you got to buy another house, then you got to move, then you got legals, you got commissions. So it adds up to a lot of money. And if you're only looking at an extra 30 or 40,000, even though that might seem like a lot of money, it's a lot less than what you might incur by making a big decision at this point.
And the other thing too is look at the terms of renewal. So maybe you don't want to renew for 5 years.
Right.
Or maybe you want to go with an open mortgage right now because there has been a reduction. There was 25 basis points that we've already had come off. There's probably more to come this year, and then it's looking like there'll be more to come next year. So if you have an open mortgage, maybe that gives yourself the ability to, as the rates come down, to be able to take advantage of that. There was another question that was asked. What advice would you give to somebody who wants to invest in private mortgages? So my advice is a couplefold. First of all, are you looking to invest in an individual project or projects? So do you want to take the entirety of a mortgage? Now, there are some advantages to that in that you don't have to worry about there being a pool of people or an MIC or something like that. Those people who do that tend to be a little bit more sophisticated. They also have a higher risk appetite, and they also tend to be investing just a portion of their wealth. So those are the ones that if you have somebody has, first of all, you should never ever ever take a mortgage on your property to invest in another mortgage, which is what I opened the webinar with, was a situation that happened in that tragic murder. And the house was owned free and clear. They got a huge mortgage on it. Then they invested in this in the private mortgage, thinking that the private mortgages would cover their existing mortgage payments. And they wound up losing not just all their money, they also lost their home because they weren't able to cover it. So you may want to look at investing in a MIC, investing in a mortgage trust. I'm going to give a little bit of an infomercial here to Foremost Financial. I would suggest you look at them, foremostfinancial.com. It was founded by my stepfather and it's an excellent place to invest. And you'd be in a pool of mortgages, and it's approximately $750 million, or sorry, $250 million fund, and maybe a little bit north of that. So that's one way you can invest in individual projects. If you want to invest in the individual projects, speak to an experienced lawyer who knows private mortgages, who understands the market, somebody who, and frankly, you want to deal with a lawyer who will only come to you occasionally. If your lawyer comes to you and says, you've got to invest in this project, you've got to invest, this is such a great opportunity, you can't miss it, that's when there should be warning bells going off in your head. You want to have somebody who comes to you and says, this may be an interesting opportunity, tells you about it, and then lets you make the decision. So those are some of the things that I would say to bear in mind in terms of investing in private mortgages. The other thing is never invest, and this is one of the golden rules of investing, never invest more than you can afford to lose. If you're investing, and especially if you're new to it, I'd suggest just investing in first mortgages. Because if you're investing in a first mortgage and assuming there's no fraud, then you know you're not going to lose everything unless the value of whatever piece of real estate you're investing in goes to zero, which I suppose is technically possible if there's an environmental issue or something like that, but not usually foreseeable. You will probably, at worst, you'll lose your interest and then you'll lose some of your principal. If you're going in a second mortgage, it's very easy to get entirely wiped out. So be careful in terms of doing this if you're going to be investing for the first time and in individual private mortgages. Are there any other questions that anybody has for us? Okay, seeing none, I want to thank everybody for coming to join us. Really appreciate it. We will be posting this up on YouTube. There'll also be links on our website, mastery.ca. If you have any questions, don't hesitate to email us, support@mastery.ca. And we will be back this fall with another in our series. Thank you, everybody, and have an outstanding summer.